If you've been looking at multifamily deals but aren't sure how to separate the winners from the losers, you're not alone. In this video, I'm giving you a clear, beginner-friendly guide to underwriting multifamily investments so you can confidently evaluate deals, avoid costly mistakes, and start building your portfolio the right way. Welcome to the channel. If you're new, I'm Paul Macaluso, the multifamily renegade, and over the last few years, I've built a $6 million plus multifamily portfolio from scratch with no partners, no shortcuts, just proven strategies. And now I'm sharing what I've learned and what I'm doing through this YouTube channel to help you guys fast track your success. If you're a beginner investor, this channel is all about helping you avoid the pitfalls and start scaling your multifamily investments with confidence. Underwriting a deal doesn't have to be overwhelming. Today, I'll walk you through my 3-step framework for evaluating multifamily properties. The first thing that we're going to talk about is understanding key metrics, the numbers that truly drive a deal's success. Second, we're going to discuss identifying critical red flags so you don't get blindsided by bad data. And the third and final thing that we're going to discuss is how to run a stress test to see if the property performs in real-world scenarios the way it should. By the end of this video, you'll have the tools to confidently evaluate deals, saving yourself time, money, and unnecessary headaches. So let's go ahead and get started. Okay, let's kick things off. The first step in underwriting is focusing on the metrics that matter. These are the numbers which are the foundation for every great deal. First things first is NOI, which is net operating income. The NOI is your baseline. Gross income minus operating expenses equals your net operating income. This number tells you how much the property is actually earning, not what someone claims that it can earn. Here's an example. A 10-unit property earning $120,000 a year with $50,000 expenses has a net operating income of $70,000. You guys following along? You get it? Okay. All right, so the next metric that you guys want to look at is the cap rate. Cap rates can be a little tricky, so only use sales data, not what's actually listed. And when I say this, I mean look at the cap rates of the properties that have actually closed escrow, not the properties that are being offered for sale. You're going to see differences in those cap rates and what's being represented. Don't fixate too much on a cap rate if you're financing a property. The next metric, in my opinion, is more important. The third metric that you'll want to look at is cash on cash return. This is going to measure the return on investment of invested cash into the deal. So here's an example. You have $100,000 of cash in a deal right now, and that could be points that you've paid on a loan, renovation costs, down payment, etc. Whatever cash that's come out of your pocket and been put into the deal, that's what you're going to use. So let's say that amount is $100,000 of cash into the deal, which then throws off $12,000 of positive cash flow annually. This is a 12% cash on cash return. Did you guys see how I did that? I hope you're paying attention. Okay, so step number 2 is identifying critical red flags. Look, not every deal is as good as it seems on paper. Here are some red flags that can derail a deal. Number 1 is overestimated rents. Look, marketing material often misrepresents net operating income with inflated rents. You want to verify market rents by checking apartments.com, Rentometer, or even going as far as calling local property managers and speaking with them. Next thing that you want to look for as far as red flags are concerned is deferred maintenance. Now, deferred maintenance on roofs, plumbing, HVAC, and more can destroy profits and actually send you to the broke house if ignored. Last but not least is misleading expense ratios. A good rule of thumb when it comes to expense ratios are that expenses run typically 40 to 50% of gross income. Anything lower than that, I would recommend that you dig in a lot deeper on the numbers to figure out what's going on and why they're so low. All right, the third and final step is running a stress test. Look, the goal isn't to break even. It's to turn a realistic and sustainable profit. Here's some things to keep in mind when doing a stress test. First of all, vacancy rates. What happens when vacancies rise 10 or maybe even 20%? I know that's an exaggeration, but run it in a stress test scenario to see what happens. Next is operating expenses. Test for increases of 10, 15, 20, 30% increase in taxes, utilities, repairs and maintenance, etc. Last but not least is your interest rate on the debt. You want to test the deal against rising interest rates. Look, if the last 3 years taught us anything, it's to remember rates can and will change. What's here today may be gone tomorrow. Last but not least is net operating income growth. Okay, you want to avoid deals that only work with overly optimistic rent projections. Stay away from those. That's trouble and you don't want any part of it. Well, that's the framework, guys. Just to recap, first thing is understanding the key metrics of the deal. 2, spot red flags and avoid them at all costs. And 3, stress test the hell out of every single deal to make sure that your investment is going to be the most profitable investment that you can make. Now, when you follow these steps, you'll avoid bad deals and focus on the ones that actually grow your wealth. If this video was helpful, hit that subscribe button and ring notification bell. I do my best to release 2 videos per week to help you build your portfolio and achieve financial freedom faster, so you never want to miss out on anything that I'm dropping. Now it's your turn. What's the biggest struggle when underwriting multifamily deals that you have? Drop a comment below and I'd love to help you out. So that's it for today's video, guys. I'm Paul Macaluso, the Multifamily Renegade, signing out, and I'll see you in the next video.